Well, good morning, everyone. Thomas Montgomery here. We get together with our distribution partners and now our clients most weekday mornings at 8 o'clock Central via Zoom to talk about strategies, tips, techniques, share success stories, and support each of you. We will allocate most of our time today, as usual, for what we call open forum. So what are the questions, the comments, the concerns, the challenges that you're facing? Because there's a good chance if you're facing that, others might be as well. Also, these daily Zoom calls are important for us to maintain what we'll call routine communication, whereby if you have general questions, we should use this time for that. We're blessed to be growing so quickly, but some of you are reaching out one-on-one for kind of general questions when we're already allocating about 20 slots, 8 a.m. every weekday to work with you on general topics. So our service model is if you're a branch, you should be scheduling weekly calls, at least once a week, maybe more than once a week, where we're going through client files, making sure they're ready for funding, making sure the clients are satisfied. So we'll call those client implementation calls. So you should have our Calendly link, and it's your responsibility to do that. But for general questions, this is a great forum to do that. So we've had a number of questions, comments, I don't really want to say concerns, but a fair amount of discussion on the trade lines. And so I'm going to go back and revisit today briefly the $100,000 primary trade line and try to foster some communication with you about it. And then we'll open it up for open forum about any topic that you want to discuss. So the credit and funding program is specifically what we work together on, right? The credit and funding program is the program that the branches are taking out to the marketplace. Incredibly valuable. That's not the goal today, but just a quick value proposition. What do? We work with clients to help them get a minimum of $100,000, legally and ethically, of course. Well, how does that happen? We help them become qualified on paper. We help them improve their 3 C's. Well, how do we do that? We help them with credit, if needed, with capacity, if needed, and collateral to help them qualify. So that's not a detailed discussion. But of those 3 C's, you might be saying, well, how do we help people with collateral? There's 2 answers, 2 layers to that answer. First of which, we provide at no cost to all clients enrolled in the credit and funding program, including those through your branches. We provide them $10,000 of assets, real assets, receivables, that they can go post on their financials that increases the valuation of their business, and it provides additional collateral for funding. So that happens automatically for free. Now, what if that's not enough? What if the client still has a collateral shortfall? Now, if you remember, a collateral shortfall isn't some fuzzy gray number that we pull out of some orifice. It is a calculation. How much funding does the client want, minus the amount of collateral they currently can demonstrate they have, equals either a collateral surplus or a shortfall. So if the client, in other words, doesn't have enough collateral to pledge for the amount of funding that they want, then we need to resolve that, and that might very well be done through the $100,000 trade line. Now, it doesn't have to be done that way. So if a client does have a collateral shortfall, we really have a couple options. One of which is we could reduce the amount of loan request, at least this immediate tranche, this next round of funding. We could lower that request amount down to the amount of collateral they have. That would bring equilibrium between the collateral needed and the collateral that they have. Or we could add more collateral. Therefore, now we can support the capital raise that the client's looking for. So just keep in mind, people don't need to add more collateral. It's just if they have a collateral shortfall, we have to bring equilibrium between the amount of funding they're pursuing and the collateral they have, done one of 2 ways: reduce the first round of loan requests to match what they have, or increase collateral to the requested loan amount. Hopefully that makes sense. One way to add collateral legally and ethically, and frankly profitably, is with the $100,000 primary trade line. So that's our topic today. So let's go ahead and discuss that. First of all, it's important to understand that the $100,000 primary trade line is primary. It is not an AU. It's not an authorized user. It is not. Secondly, we don't sell trade lines. I think anyone that's selling trade lines, that's murky at best. So how do you get a trade line, whether it be you, me, or anyone else? You would apply for credit, you'd get approved for credit, you would use that credit, and then the data furnisher reports that transaction on your credit. So what are examples? A house. Do you just go add a mortgage to your credit profile because it makes it look stronger? Probably not. You'd probably go to jail for that. But what you could do is you could apply for a mortgage, you could get approved for a mortgage, you could take the mortgage, and then when you pay your mortgage on time, guess what happens? Then typically the issuer of the mortgage, what we'll call the data furnisher, will report to one or more of the bureaus that you've paid on time, and now you have a new trade line. So trade lines are the outcome of an extension of credit. So we don't sell trade lines, but we do have an innovative, legal, and ethical way of adding trade lines. So let's go through how that works, because this is of tremendous value to many of your clients, and it's a huge moneymaker for you at the same time, because you make $5,000. Take, who was it last night? It'll come to me in a moment. Carlton made $5,000 yesterday by placing one $100,000 primary trade line with his client. So you can make $5,000 same day by flipping a trade line. But let's talk about the value proposition to the client first. There are a few things that we need to know about trade lines, and we've already differentiated. There is a difference between primary, which is what we're talking about, and AU. So we know that. We've covered that. But also size matters, and that's not some sort of adult joke. Size matters when it comes to trade lines, because the larger the trade lines that are reporting on your individual personal and or business credit profile shows that you as an individual, or your business has managed larger extensions of credit. So when the next loan or finance application that you submit, they're going to look at what type of credit you've had extended before in terms of amounts, and also often will use some sort of formula off of how large of an extension of credit you've managed in the past. What's a simple example? Take an 18-year-old. We'll do a college graduate. Let's do this. So you go to college, you graduate, you got your job offer, but you haven't even got your first paycheck yet, but you got an offer letter from your employer. You can go to a car dealership and get a car financed, brand new car. Now, even though you don't have any auto credit. But what are you going to get financed? You know, a moderate vehicle, a Camry and Accord, something mainstream. If you went into a Porsche dealership and said, hey, I want a Porsche 911 financed, even though I don't have any auto credit, do you think you'll get approved for that? No, not without a real large down payment, most likely. So in general, size matters, and that's why when we're adding primary trade lines, we're adding a really large $100,000 primary trade line. So size matters. We don't want to add, it can in fact hurt a client adding small trade lines. Small trade lines, while may help benefit the credit score to a smaller extent, it often will reduce the fundability, at least in the short term, of a client, because we're adding itty-bitty amounts. And so what's the next extender of credit going to do? Probably offer another itty-bitty amount. As we mentioned, we don't pay for trade lines. And again, these are real trade lines. Now, since we're not selling the trade line, it's important to understand what I just referenced. Trade lines are the outcome of applying for credit, getting approved for credit, and making some sort of purchase, whether it be a mortgage, an auto, a business loan, a credit card, business credit card. Here, what we use innovatively, and there's a couple trainings that you can watch on this page on the $100,000 trade line if you want more background. But what we're doing is literally transferring $100,000 of real receivables, not wink, wink, not pretend, real receivables. So accounts receivables are, of course, an asset that can be bought and sold. They count as a current asset on your balance sheet, which is great. And then we literally can help the client liquidate those receivables and turn it into cash because they're real receivables. So when you think about the value proposition of this $100,000 trade line, it's kind of mind-blowing. So does it resolve the collateral shortfall? Yes, immediately. Within 24 hours, the collateral shortfall is gone. So now we're ready to move on to funding. So that's the most obvious benefit. But also, since it's reporting on the client's credit profile, now we've built their credit profile. So not only have we resolved the collateral shortfall, now we've materially strengthened their credit profile, which is awesome. And then even better yet, then we help them liquidate those receivables and turn that into cash because, again, they're real receivables. So now we've actually helped all three C's. With just the trade lines, we've helped with credit, collateral, and capacity because by liquidating the receivables turn into cash, now we've increased the borrowing capacity of the business because the business has more money coming into it and it can afford a higher loan payment. It's huge. It's huge. So I'm going to stop talking and start listening. So each of you, we've got 419 of you on. So thank you for joining us this morning. You're in the right place. But we need to address questions, comments, concerns that you all have because these trade lines are an important arrow in the quiver that our branches have. All right. As usual, Timothy has the first question. So, Timothy, I'll just paraphrase. Normally, you don't go out and sell or pitch these trade lines. Instead, you bring clients in to your branch's credit and funding program. You get them onboarded. What does onboarding mean? You get their agreement, their refundable setup fee in full or the $250 down payment. You help them complete their PFS. You help them complete the soft pull. Those are the 4 data elements to have a client file. Then we hop on the phone and we look at the client's profile and start working on their funding plan. Obi's on the call this morning. Welcome, Obi. And I just talked to him and his business partner this morning. Obi's got 1 client, I believe this is true, under contract, several more coming. So what will happen is Obi, well, he just did actually, he'll schedule a call with us using our Calendly link. And then we'll look at each of his clients that have those 4 criteria met: agreement, payment, PFS, and soft pull. So now Obi and I were looking at the client's profile and determining, is that client ready for funding right now for what we call first tranche? And then what do we need to do to get them from where they're at to where they need to be? And so if Obi and I are looking at that client's profile and realize they have a collateral shortfall, then we would start exploring options. So we're not talking to Obi's client. We're not talking to any of your clients. You manage the client relationship. But if there's objectively a collateral shortfall, we'll probably explore, would this help them? And if so, then you as the branch can introduce that to the client. So the point is, this is a solution to a problem that will organically show itself once the client has enrolled and been onboarded. We don't really need to go out and pitch this. While it can be sold on a standalone basis, normally it's a resource to resolve a collateral shortfall for clients in credit and funding. Hopefully that makes sense. Okay, so then next question is cost. So the $100,000 portfolio, and again, if you've not watched these two trainings, I encourage you to do so. They're parked here on the $100,000 Tradeline page. So we provide $100,000 of receivables to the client. So that puts $100,000 of collateral on their financials. We discussed that. Clients will pay whatever you want them to pay for that. So what do I mean? You buy the portfolio at wholesale, just like Carlton did yesterday, and then you sell it at retail. And I'm going to give you all the details. I'm just painting the picture. So we sell the $100,000 portfolio for 5 cents on the dollar wholesale. So that's $5,000. Now it's really worth $100,000, right? So it's a great deal. But the branch buys it at wholesale, $5,000, and then turns around and typically will flip it and sell it to the client for retail, which is $10,000. Thus, Carlton just made $5,000 yesterday. All of you can make $5,000 by flipping the portfolio. Then we work with the client, get it posted on their financials, help them liquidate it, and turn that into cash. So that's the answer to Ron's question of cost. Wholesale for a $100,000 portfolio of receivables is $5,000. Ron, that's what you would pay for it. Then you turn around and sell it to the client for whatever you want, but normally $10,000. Thus, you've doubled your money in 24 hours. Ron, did that answer your question? Okay. And Ms. Dash mentions she's got folks that are interested in being a branch office as well, and that's great. So this is great information, and we're very, very transparent, right? So for these morning trainings, we make them available to anyone and everyone. We record them, we post them up on our YouTube channel. We don't put a password or restrict it, so it's fine for the world to see. This is absolutely a legal model. The largest portfolio we've ever sold was a $3 million portfolio to a law firm in Austin. Primarily, though, we do small portfolios, $100,000. So if a client needs more than $100,000 collateral, in other words, they have more than $100,000 collateral shortfall, they can certainly get multiple portfolios if they need, but the process is the same. So we normally don't change the size of the portfolio. Each is $100,000 of receivables. You buy wholesale, 5 cents on the dollar. Client pays you retail, unless you change that, which is 10 cents on the dollar. So you could have multiple portfolios, but this is all standardized. So each portfolio will be 100,000. All right, so let's see. We have Peter's got a question, and his is there a time limit for fund drawn? I don't know what that means, Peter. I'm sorry. I'm sure it's just a language barrier that if you ask the question differently, then I'll do a better job of answering it, but I don't know how to answer that question. All right, so first, let's just step back. Does everyone see the value of the trade line? Because if not, I failed you, right? Because you're going to have a lot of clients that have problems that we can fix with this one arrow in your quiver. If they have a collateral shortfall, check. We can check that box. We can fix it. Let's say that their credit profile is a bit thin, or maybe they have high revolving utilization, so adding a new primary trade line would dilute that. Check that box. What if they just need more money? So it's the same. The analogy I use, and maybe you like it, maybe you don't, is let's say that you and I see that there's a rental house for sale. Well, let's say a house for sale. So you and I buy that house. We're going to buy it. You know, it's not going to be given to us. That's too good to be true. But we could turn around and rent it out and create positive cash flow. So when someone is buying a portfolio, they're buying $100,000 of receivables. They're getting a great deal, right? You're selling it for 10 cents on the dollar, and we're going to work with them to liquidate that to obviously get a positive return on investment. But they are buying the asset. I think anytime someone's giving free assets away, you need to step back and say, well, does that make sense? Well, we will give $10,000, a small portfolio, to each credit and funding client, automatically free, no strings attached. But above and beyond that, it's not free. They would buy it. They would buy it from you. You would buy it from us at wholesale. You would sell it to them at retail or whatever price you want. All right, so let's dig into the questions that any of you have. Ron says powerful. I agree. Trevor says yes with exclamations. Trevor's asking about reporting. Okay, I can tell you about the reporting. So let's dig another layer deep on reporting. So here's what you need to know. So if a client is wanting to have this report on their credit, and it can report on personal and or business, then we would have them apply for financing for the purchase. And we have a nonprofit microlender that does a guaranteed approval, 0% interest. And so now the client has a new trade line that will report on both personal and business. Now, I've talked to these folks many times, and they use Metro 2 and all the sophisticated software. One caveat is if the client doesn't have a business entity, then it won't report on their business credit. And you might say, well, of course, but I don't want to oversell and underdeliver. So the trade line will report on the client's business credit profile as well as personal, but I'll get to the personal in a minute. But to have business credit reporting, of course, the client has to have a business entity. Probably obvious to you, but just want to make sure. But then it can also report on the personal side, and they're not charging for that data furnishing and there's a lot of work and cost for that. So the question was, does it report differently on personal or business? The answer is no. It's set up as a revolving account in both cases. And those of you that are trained in Metro 2, what is it, a W code? Is that right? A W code if it's on the business side, and some other code if it's on personal. I don't have that technical expertise, but we work with a 501c3 micro lender that handles the financing and the data furnishing. So that we don't do that directly. We're not a data furnisher. Okay, so that was Trevor's question. Brenda says, with my clients that require larger amounts, they need this resource. Yeah. And again, it's a calculation. You're filling out the PFS, the personal financial statement, with them. So you see what assets they have to pledge for collateral, and it's just a mathematical formula. If the amount of funding that they want exceeds the amount of collateral they have to pledge, then they have a collateral shortfall. So then we have one of two things: either reduce the loan amount to what they have, at least for this first round, or increase the collateral to match the loan that they're requesting. Simple math. And we'll help you with that and support you with that. But what's great is it's providing tremendous value for the client, and you're making $5,000 for flipping it. And again, I know a lot of you are big hitters, but if you're already making $12,000 per client gross income, you add this trade line and you just added $5,000 more to it. So now you're at $17,000 a client. If you're just doing the norm, now some of you are bigger hitters than others, but if you're just doing the norm, one new client a day, do the math. And I'm going to have to pull up my calculator. I'm not that good at math in my head. But now if you're making $17,000 per client gross income, and you do that over 30 days, now you're right at $500,000 of gross income for your branch per month. That's good. I mean, some people don't make that in a year, and you're turning that in a month. And it's real money. It's real programs. It's legitimate, right? So this is great. All right, so Trevor says outstanding. Eric's asking about the reporting of the trade line. So we first got to clarify, we do not report on credit. We're not a data furnisher, as the industry is called. Now, if someone doesn't pay us, we work with a collection agency that does report negative. But here we're talking about reporting positive, not reporting negative. And so the 501c3 microlender reports just as is normal once a month. And I've seen them do it, right? They've got this expensive, elaborate software, and they do this upload into the bureaus, and the bureaus receives it, and they process it, and they post it. So it's real. It works. I've seen it. No, there's zero doubt that it's legitimate and that works. But Eric's asking about timeline. Well, just like with most things, cars, homes, business loans, anything, typically data furnishers normally report once a month. I'm hoping, kind of praying, trying to persuade them to start reporting weekly, but right now they report once a month. All right. Sam's asking about age trade lines. So yes, in certain circumstances, the primary trade line can be aged, but only for 2 years. So just keep that in mind. Only 2 years of aging. Andrea asked if they don't have the funds. Well, and before I go on with Andrea's question, yeah, so you might have a client that enrolls in the credit and funding program. You get them onboarded, and then we're working with them on their 3 C's. And let's say that they have a capacity issue. This means cash flow. This means money as depicted by the faucet. So it's fine. If clients have a weakness in any of these 3 areas, that's great. They're in the right spot. We're here to help them. And so Andrea's question is, well, what happens if they come in and they have a capacity issue? They also have a collateral issue, but they don't have enough money, have enough capacity to be able to get the trade line. It's okay, right? We've already said it's okay. Then we can get an initial tranche of capital, a round of funding, if you will, that matches the collateral they do have. And then we can build from there, because some clients are going to need to take steps towards getting to their ultimate capital raise goal. But yeah, don't worry about clients that have money problems. We can always fix money problems. We never worry about bad credit. We never worry about money problems. We never worry about collateral. All 3 of these 3 C's can be legally manipulated, modified, legally and ethically. So that's fine. That's who we're here to help, right? If they were perfect on paper, they probably wouldn't need you and I. So that's fine. All right, we're about out of time. Let's see if there's any other. James is asking about the microlender. Yeah, so what will happen, let's go back to the right page, is you, James, and everyone else, you bring on clients into the credit and funding program. What you promise to do is, after a 30-day grace period, bring in at least 2 clients a week. That keeps you compliant. We've discussed this, right? If you don't refer in at least 2 clients a week, then you're not compliant. And if you're not compliant, then we need to talk. We need to figure out what's wrong. What can we do better to help you? Is it you don't have enough leads? Great, we'll get you leads. Are you having trouble closing or converting? That's fine. I was talking to, I'll digress for a minute. I was talking to one gentleman yesterday, and you all know I have stage 4 cancer. You don't care about that. But this guy is sick too. And so he's sick, and he doesn't have the energy to be able to do what you and I do. So we came up with a plan. So we're hiring a manager for him. So he'll own the branch, but he'll have a manager that's running the branch, and then he'll have reps underneath the manager doing the work. So it's okay. We're going to work together to overcome obstacles that people have. And even if it's any of these 3 C's, we can overcome any of these 3 C's. And even if it's bandwidth or health issues, we will work around that. Because you can own a company without doing the work, right? And that's what he needs to move into. He doesn't have the ability to do the work. All right, well, I think we covered a lot. Hopefully this was helpful. Our goal today was to give you a reminder of this very, very important value proposition that we have, which is the $100,000 primary trade line. It's legal, it's ethical, it's very effective, and it's unique It's unique in the aspect that it literally helps clients fix all three of their C's. It improves their credit profile. It improves their collateral instantly. And it even improves their capacity. It creates new cash flow for them. So that's outstanding. All right, well, we'll be back tomorrow morning. We'll dig deeper into other topics. We're out of time today. Thank you all. Let us know if you need any assistance, and I'll talk to you soon. Bye-bye.